Good morning. Welcome to IG's early morning call. It's Monday, 20th of February. Let's take a look at the headlines as we work into a week where we see the first anniversary of the attacks in Ukraine by Russia. But the big question is for the markets, can the FTSE continue to rise to new higher highs? We're on a stronger start to the trading day today ahead of earnings out this week, with more from the banking sector, with HSBC and Lloyds heading the list there. Also, we have a Rio Tinto report to come in the week later on. Also, big week for central banks. We've got the Reserve Bank of Australia and the Fed on minutes of the last meeting and an interest rate meeting with an expected rise in rates from the New Zealand Central Bank. And we'll take a look at US earnings in focus this week. It's all about retailers backing up the final quarter of 2023. A number of big retailers coming out. Also on the list of stocks to watch, Nvidia. Take a look at what's happening, first of all, in the London markets, with this record high on the 24-hour markets that we saw last week of 8,044. The red dotted line you can see here. If you weren't with us on the early morning call last week because of half term or whatever it was, let me just quickly remind you that we had this analysis which came through where we saw this band here between 72.96 and 78.76. I drew this this green dotted line here, and I extended that, and using this extension analysis, we have here a record high potentially of 84.56. Now, to get there, we've got around about 400 points. Is that possible? Well, it's certainly possible. Is it achievable? Possibly. It all depends, I think, very much on how the markets treat the incoming data. We know that inflation remains high in the UK. We know the central bank, the Bank of England, keeping its foot on the pedal for interest rates. And this is likely to steer further softness in the economy. Could we go into recession? Very likely. And all these factors could well conspire to keep a lid on any gains. That being said, there's not many other places for the markets to go. And we're seeing some of these companies come through with earnings that are not too bad on the whole. We're waiting banking earnings out a little bit later on this week. So expecting a stronger start to the London markets. And it's the same sort of story across the European markets. The German DAX, not quite as high as we were intraday back on the 9th of February, but nonetheless attracting money on this Monday morning at 15,524. And in the French markets, the French CAC 40, last week we saw a new all-time intraday record high. It was only by the slimmest of margins away from the highs that we had back on the 4th of January 2022. But one-year highs, or 13-month, almost 14-month highs now for the French CAC 40. And indeed, we're building on Friday's close, where we saw a record close for the CAC 40. Let's take a look at what's been happening overnight in the Asia-Pacific markets as we see things there trading with gains pretty much across the board. Slimmest of margins pretty much on the ASX 200. Same sort of performance on the Nikkei 225. It'll go down the history books as gains on the day. Hang Seng Stock Index continuing to trade on the session, up more than 1% on the trading day today. Wall Street closed on Friday. This is how things ended out the week. The US stock and bond markets will be closed today for the President's Day holiday. We saw a gain for the Dow, S&P 500 and the Nasdaq on the way down. Interestingly enough, I was watching some of the news over the weekend, and news that Jimmy Carter, the oldest living former president, has gone home from a hospice to spend the rest of his days with his family. Our wishes to the Carter family. Just a quick update on where we are in terms of the markets, despite the fact there'll be no stocks trading and no cash trading today. You can trade these markets 24 hours on the IG platform as of the beginning of the Monday session. And we are, as you can see at the moment, pretty much where we closed out Friday's trading day at 33,808. And the biggest moves coming through on Friday on the tech markets, or the back end of last week, I should say, on the tech markets, with declines across the board. And you can see at the moment we've got another red candle there, building on the losses that we saw towards the back end of last week. 12,458, 58 for the Nasdaq. Now, we've seen the Chinese monetary authorities coming out with some news out overnight with the loan prime rate. As expected, we've got things absolutely unchanged on where we were as of the prior day. First-year loan, one-year loan prime rate 3.65%, five-year loan prime rate 4.3%. The right move house price index was pretty much flat for the month of February compared to January. To be precise, the average asking price for a home across the UK rose by a margin of £14. A surprising number considering February usually sees a big seasonal increase. It was the smallest February rise on record year on year, asking prices rising 3.9% overall from this time last year. Rightmove said the minimal increase, effectively zero in percentage terms, suggested that property sellers were heeding advice to price their homes realistically in order to sell them, if that was their intention, into a market which has slowed sharply in recent months. Now, what's it mean for the foreseeable future? This is what Tim Bannister, Rightmove's Director of Property Science, says. Frantic market, years of unsustainably high prices in the long term. Our key indicators now point to a market which is transitioning towards a more normal level of activity after the market turbulence at the end of last year. Let's take a look at the FTSE 350 Household Goods and Home Construction Index. This is the index which contains those big house builders such as Barratt Developments, Taylor Wimpey, Redrow and so forth. And you can see that going into the low part, we saw at the length of October last year, we've seen a 44.47% increase in this index up to the highs that we saw back on the 2nd of February. Since then, a little bit of a drop down, and we're opening today at 115.35. I'm not suggesting this is necessarily going to move the markets on the whole, but I think this is broadly another swipe across the bows of the household construction sector, warning that things are beginning to soften in this area of the market. Elsewhere today, let's take a quick look at what we got in terms of the Eurozone, because we've got the EU flash consumer confidence number out, expected to rise to a negative 19 in February after a negative 20.9 in the previous month. So that's at 3 o'clock this afternoon. Meanwhile, in the central bank's diaries, there are headlines to follow. Tuesday brings more detail from the Australian Central Bank, where the minutes are released from the last meeting at which the authorities raised rates by 0.25% to 3.35%. Wednesday sees the New Zealand Central Bank, the RBNZ, on rates expected to raise a further 50 basis points to 4.75%. Fed minutes on Wednesday, 1st of March, from the last meeting at which the US Central Bank raised rates 25 basis points to between 4.5% and 4.75%. The report will highlight the voting, and despite a unanimous vote for a 25 basis point rise in the Fed funds rate last time around, non-voting members such as Bullard and Mester favoured a 50 basis point hike, despite the fact they don't have a vote around the table at the moment. James Bullard's speech last week saw him suggest he believes that 50 basis points is still needed at the March meeting. Also out this week, we got the G20 finance ministers and central bank governors meeting. This one is a two-day meeting in India starting on Thursday, with debt relief measures for emerging market countries likely to top the agenda, and above all, China's potential role in all this. Just want to quickly take a look at what's happening on the foreign exchange markets, just a sweep round of what's going on, despite the fact we got a holiday today in America. We've got further strengthening of the euro on the back of what was a strong day for the euro over the US dollar on Friday. It's not lifting much in the grand scheme of things. This is only a small retracement on the losses that we've seen since the highs we had back for the euro dollar back on the 1st of February. Currently trading at 107.01. If you're long on this, your stop goes down here at around about the 105.90 level below Friday's lower part of the candle. Just to wrap some of the other areas of the market, this is sterling against the US dollar, sterling up for a second day. And the other area of the market I think to watch out for would be the Australian dollar against the New Zealand dollar, bearing in mind these two central banks out with details this week, the Australian Central Bank on minutes of the last meeting. And you can see here the Australian Central Bank, the Australian currency, I should say, over the Kiwi has breached what we have seen here was previous resistance at 110.46, which were the highs we had back on the 11th of November. And indeed, this is pretty much the first time we've really seen the serious activity beyond the 200-day moving average since October last year, with this punch higher for the Australian dollar against the Kiwi. We'll be watching these out as we see the New Zealand Central Bank on its meeting this week on rates, and the Aussie minutes out as well in the coming few days. Now let's take a look at one story that's been developing over the weekend. We saw Mark Zuckerberg come out with a speech at the weekend, and he has delivered some interesting news. He says that Facebook, Instagram and WhatsApp owner Meta will launch a paid subscription service costing $14.99 a month that will allow Facebook and Instagram users to verify their new accounts. Now, this new feature called Meta Verified lets users obtain a blue badge, get extra impersonation protection against accounts, and get direct access to customer support. Forgive me if I've got this wrong, but I thought that the GDPR rules meant that these companies had already had to have something in place to protect us as consumers in this area of the market. And here we are now having an announcement at the weekend that Meta, which is, as I say, ownership of Facebook, which is around about 18 years old at the moment, it's now wanting to find new ways of getting money from users. And this is one way they perceive will be the right way to do it. If you access your Facebook through the web, it will only cost you $11.99 if you want to get these verified accounts, $14.99 a month on Apple's operating system or Android. The Financial Times says today that Meta Verified, as it will be called, will be rolled out first in Australia and New Zealand this week. But as I said, I think so far as us as the consumer is concerned, we do expect a certain amount of protection in any event. So I'll be interested to find out just how this works out and what the appetite is for this. But of course, a lot of people use Facebook and won't want to be losing out on anything. Let's take a look at what's happening with a Meta trade. Of course, we won't get any trade on this stock today because of the President's Day holiday. But just to show you, it ended out the week at 173.25. Now, after Barclays and NatWest disappointed the markets last week in terms of banking earnings here in the UK, we did see some good numbers out from Standard Chartered, it has to be said. This week, it's the turn of HSBC and Lloyds Banking Group to report on Tuesday and Wednesday, respectively. But it's not just banks that could move the market. Rolls-Royce, Rio Tinto, WPP and Anglo American all scheduled to post full-year earnings. Just wanted to quickly wrap where we are in terms of the move up on stock for HSBC. I think this is an interesting story, bearing in mind the gains we saw last week. Just looking at the chart here for HSBC, the gains we saw last week for Standard Chartered. Standard Chartered and HSBC have a lot of overlap in terms of the markets they're in, because HSBC, like Standard Chartered, has a lot of business in the Far East. And you can see here this move up that we saw on Friday, taking us to intraday levels on this market, not seen since the 25th of September 2019. So it was a good performance last week, despite the fact we saw, as I said, Barclays and NatWest fall short of expectations. Lloyds Banking Group, I suspect, could well see some potential frailties, I think, build up on this. The problem with Barclays and NatWest, and especially NatWest, was the consumer divisions and worries about the amount of bad debt provision the companies may have to put aside because of the exposure to mortgages and consumer debts. And indeed, this is the same case for Lloyds. I think this is more a case for Lloyds, but you can see on the back end, what's Wednesday and Friday last week, some relatively hefty losses, 3.71% down for Lloyds late last week. And when we see the numbers come out from Lloyds Banking Group on Wednesday, interesting to see whether or not this stock goes down any further, if there is any more concern about what's happening with the consumer. Meanwhile, we're at the tail end of the US earnings season. Just a quick wrap of where we are in terms of some of the numbers out this week. Bearing in mind, as I said, we've got no trade today on the US. Tomorrow, we've got Walmart, Home Depot and Coinbase. Wednesday, Nvidia and eBay. And Thursday, we have Moderna out with numbers. Now, all these stocks trade all sessions on the IG platform. No trading today because of the President's Day holiday. But when they start tomorrow at 9 o'clock in the morning UK time, we get trade throughout the trading day. And you can trade these stocks on the IG platform when they produce their numbers. Let's look at some other areas of the market, just a couple of other areas I want to follow up on with what's going on the crude oil markets. This is US crude where we are. We are pretty much holding last week's drop, which came about on expectations that supply is beginning to increase. And there's some question marks as well about demand on that side. So this has seen the oil price drop. That being said, today we do have a small rise at 77.18. On Friday, the Baker Hughes rig count fell by 1 to 760. The number of oil rigs in operation fell by 2 to 607. Just return to the charts and catch up on what's happening with gold. Second day in a row of gains today at 18.45. That's it from me. We're back at 10:30 as we head to charting the markets this morning. Hope you can join us there for that. As I said, no trade today because of President's Day in the States. But you can trade these markets 24 hours on the IG platform. And we'll be looking ahead, as I say today, in earnings out later on the week from the banking sector. But do watch out for some of those house builders on that news of the softening continuing in the house price index.